Good morning and welcome everybody. My name is Jan Peters and today we will talk to Urs Ramseyer, CIO and founding partner of 12 Capital, and Rodri Morris, head of ILS Analytics at 12 Capital. So why are we here today? 2022 has been another big year for US hurricane risk, and 12 Capital has finalized a paper on hurricanes and climate change. And in the meantime, we've also seen a significant increase in reinsurance premiums and spread widening in the cat bond market. So what does this mean for ILS portfolios? Firstly, how does climate change impact US hurricane risk and the expected loss of ILS portfolios? And also, how does 12 Capital manage these hurricane risks and the impact on climate change within the ILS portfolios? So let's take a step to what is ILS trying to solve, and that is the protection gap. And the protection gap is the difference between the insurable values of, let's say, properties and the actual insurance that is purchased against it. And I believe this is a good moment to move over to Urs, please, to tell us a little bit more about that.
Yes, thank you, Jan, and good morning, everybody. Welcome to this webinar also from my side. What you see on this slide are the losses due to natural catastrophes over the last 50 years, so since 1970. And you can see a significant increase of economic losses due to natural catastrophes, to a certain degree due to global warming and climate change, and we get into this in more details in a few minutes. But what is important here is the light blue are the economic losses and the dark blue are the insured losses. So we do not only observe an increase of natural catastrophes over the last 50 years, but we also observe a widening gap between the economic losses and the insured losses. This means that more and more people are exposed to these catastrophes, but do not have insurance coverage. If we look geographically where the biggest gap is in terms of protection on the next slide, then we can see it's still in the US, where we have a big protection gap, followed by Japan. China, the protection gap is increasing significantly over recent years due to the values, the economic values in exposed regions, followed by Europe. But what we should not forget in the emerging markets, in the developing countries, people are not insured, and that's basically where the biggest gap is in terms of protection. Globally, currently, 2/3 of the population does not have insurance against natural catastrophe, and this creates a massive opportunity for cat bonds and ILS, and we will get later into more details about this opportunity. And with that, I hand back to Jan.
Right, thank you, Urs. So we do see that there is a protection gap in most countries, and climate change is making this even more pressing. And with that, I believe, let's move over to Rodri to tell us more about climate change in this respect.
Thank you, Jan. So we'll start off with a general overview of sort of what climate change is and why it matters to the ILS market. So first of all, a changing climate can produce increasing frequency, so potentially more events, or as well as it can produce higher severity. So when an event happens, it's bigger than it might have been previously. And both of these really combine to increase the level of uncertainty. What we have done here is showing sort of a variety of, should we call them perils, and then how likely they are to be impacted by climate change. So we see hurricanes at the top. We expect a moderate increase over the coming decades. Earthquakes and tsunamis, we at the moment see no sort of direct impact to that. But then interestingly, these last two of flooding, thunderstorms and wildfires, we see as more, should we say, frequency impacted. So we've seen a large uptick in the number of events that are happening. Why does this matter? And so this can impact the ILS purely because risk and uncertainty is increasing, but we'll go into more detail later. But fortunately, a lot of the ILS instruments are short dated, so we don't have to simply sit here and take this increase in risk. We're able to restructure and reanalyze where we are. And also we're able to use currently available catastrophe models, as well as the research, which we'll talk through shortly, in order to capture this risk. Here is a sort of a graph looking at what we'll call non-peak perils, and so primarily looking at thunderstorm, wildfire, and winter storm over the past 20 years. And it should be pretty clear from this that there's a pretty big increase going from sort of the late 90s through to now, dominated primarily by thunderstorm. And this is something that a lot of insurers in the US have been experiencing of this, particularly over the past decade, with quite a big increase in frequency of thunderstorm events, causing these, pretty large losses going through time. We can then also look at what we call more peak perils. And so this is then showing a similar graph, but now including things such as earthquake and hurricane. And what we can see is as and when hurricanes happen, they are often the driving force of the loss throughout the year. We can see here in 2022, over 50% of the losses through this year are from hurricanes, and primarily being driven by Hurricane Ian, which we saw went through sort of a rapid intensification before making landfall in Florida. And similarly with 2017, with the HIM events, the Harvey, Irma, Maria, as an example, Hurricane Harvey was quite a wet event where it caused a lot of damage from flooding. And this is a trend that we're seeing sort of in hurricanes in the future.
So with climate change kicking in, Rodri, what can you tell us about the risk?
I suppose, long story short, risk is going to increase, either because more events are going to happen. When they do happen, they're going to be larger. So this map here is showing us for the ILS market, what kind of risks are usually covered. I'd like to draw your attention to sort of the pie chart on the top right. And this is sort of why we focused on US hurricanes as part of our climate paper, which we'll be going through shortly. It's that around 62% of the catastrophe bond market has some element of loss that can come from US windstorms. So clearly it's an incredibly important part of the catastrophe bond market, and is why we have decided to focus our research on this. So onto our research. This has been done in partnership with a company called Reask. We've had a relationship with them for the past 4 years. They are a climate tech sort of insurance technology company that use more modern techniques such as machine learning and AI to look at both past trends as well as sort of climate signals that we're able to predict.
Why is it Reask and not using the traditional models?
So yeah, we use the traditional models as part of our analytics, but what we wanted to do here is have a slightly more forward-looking view than we think maybe the models currently have. There are settings within the models that we use that look at a more short-dated history, so taking into account maybe more recent climate trends. But the work we're trying to do with Reask is really that more future-looking into sort of the next 20, 40, 60 years. And so, yeah, to get into it, I first of all encourage you all to go and download the paper. And should you have any questions, you can reach out to us afterwards. But the first thing we can look at is hurricane risk, we believe, is going to increase. What we're seeing here on the left-hand side is the number of hurricanes that are expected on average per year, given our control period of 1990 to 2020, and then our two projected sets of years. So we've got 2020 to 2040 and 2040 to 2060. Basin activity refers to the entire, Atlantic of where hurricanes can form. But what we really care about in the ILS market is landfalls, i.e. when a hurricane is going to impact exposure or properties, they may generate a loss.
When you say we see an increase in the number of hurricanes, does it mean that the risk is going up equally?
No. So what we expect here is actually two interesting points to look at. So first of all, if we focus on the bottom line of these two tables, we believe that the East Coast is going to see a relatively larger increase in hurricanes than the rest of the US. And so for us, the East Coast is obviously the East Coast of the US, north of the Carolinas. So what we can see here is that, relatively speaking, we're going to see a much bigger increase in these. And that's important because it might be an area that hasn't seen very many hurricanes in the past, which is true. And so we don't necessarily know how well those properties or the insurance companies and the infrastructure is going to be able to deal with, potentially more frequent and bigger hurricanes compared to their southern counterparts. The second split that we noticed is when you look at major hurricanes versus what we'll call normal hurricanes. So a major hurricane is a category 4 or 5, which we can see on this right-hand side. And we're actually seeing, again, bigger relative increase in these larger hurricanes. And so if we take a look at the overlap of both of those, we can see the East Coast landfalls, relatively speaking, in 2024 to 2060, we're seeing an almost 100% or a 200% increase. It's worthwhile keeping in mind that still the number of total hurricanes we expect is on the lower side. But just to put it in context, is that given our control period, we expect maybe a major hurricane to impact the East Coast once every 30 to 33 years. Versus in 2040 to 2060, we expect that to be more like the 1 in 10, 1 in 15. So to give it context, there is this tangible increase that we're expecting.
So if we do believe this is going to happen, the question is, of course, what are we going to do about it?
So first of all, we'll look at what does this mean for an ILS manager or an ILS portfolio. So first of all, risk is going to increase again via frequency and or severity. We've got this potential change in landfall locations of where we're going to see a move or an increase in activity up the East Coast, where there is less hurricane preparedness than a state like Florida, which is used to hurricanes on a very regular basis. We also need to take into account, should we say, non-climate impacts as well, such as inflation and particularly population and wealth growth. So the amount of exposure that is out there is ever increasing, and which obviously adds into the earlier point that Urs made around the protection gap, that people are going to maybe now in the East Coast need more protection than they have in the past. But I think I mentioned earlier that we in the ILS space don't have to remain static either. It's collateralized ILS transactions usually have a lifetime of 1 year, while catastrophe bonds have an average of 3 to 4 years, which means we have the opportunity to sort of reset and rebalance over time. So if we know or if we believe that this is going to happen, we can start, understanding what changes and what things we might want to look at going forward. That might be an increased in attachment point. So, a larger insured loss needs to happen before we start paying out on that catastrophe bond. And finally, risk premium will likely increase. If there's going to be an increase in not only risk, but uncertainty, that's where, we will be able to charge a higher risk premium for that.
Okay.
So then more specifically, yes, on 12 Capital's approach. So first of all, particularly within our catastrophe bond fund, we focus more on the systemic risk, not the idiosyncratic. So we are taking a much or slightly higher view, looking at the US or US hurricane risk, rather than focusing on individual companies, which may end up having higher exposures in some of these areas where we're going to see greater uncertainty. Just like this piece of work we're talking about, we also have other pieces of work that form our view of risk, which is incorporated into each piece of pricing and investment analysis, and then ultimately portfolio construction. And linking back to the point we mentioned earlier, we want this to be forward-looking, as well as obviously being informed by what's happened in the recent past. And we also think at 12 Capital, not only of the quantitative, but looking beyond the modeling. And so we do legal analytics to make sure that the contracts are clear and appropriate. And this will be important going forward to, to ensure that they are well-defined going into a more uncertain world. And also our counterparty review. So who is the cedent or the underlying that we're protecting? Are they well placed to underwrite the risk? Do they understand, how climate change might impact their portfolio? And so we want to obviously partner with people who have that understanding and how they're going to look at risk. And then finally, we do use these what we sometimes call warm sea surface temperature or near-term rates. So using more recent history to inform our modeling choices, given that we've seen maybe a higher warm sea surface temperature in the past decade or so, which leads to more events happening. And so all of these are applied to our view of risk and then ultimately instrument analytics as well.
Right. So, Rodri, I saw a question coming through, and you mentioned something about higher attachment points at some point.
Yes.
Does that mean there will be more risk remaining in the insurance sector, and what does that mean?
Yes. So it all depends about what sort of, I suppose, level of risk and return each participant wants. So if the catastrophe bonds stay at the, should we say, the level of risk, if we assume that that's what investors are happy with, naturally the catastrophe bond attachment points will have to move up, given that there's maybe more exposures, bigger risk etc. But solving the protection gap is something that, the ILS market, as well as the general, reinsurance market, is here to solve. So I think it will give more opportunities for, should we say, slightly more creative structures or potentially different risk appetites, as well as, needing for that risk to be appropriately paid.
Given that we see an increase in risk and uncertainty, at the same time, we also see opportunities. And I believe this is a good moment to move over to Urs. Please, what can you tell us about these opportunities, Urs?
Climate change, as you mentioned, is a big opportunity for the ILS market in general and the cat bond market in particular. What you see on this chart are the yields of a cat bond market as we currently have it, and you see a significant increase of spreads. That's the dark blue one, and then the risk-free returns, that's the gray one, over the last 12, 18 months. So the cat bond market has a current yield of roughly 14% and continues basically to increase. And this increase of yields is mainly due to an imbalance of capital. So there is more demand for protection in the market than there is capital available to give this protection, and that drives reinsurance premiums up, retro premiums up, and ultimately also the cat bond spreads. So I can say now, after 15 years of experience, these are the highest yields and spreads we have ever seen in cat bonds we currently get in this investment strategy.
So Urs, and so yields are going up, spreads are going up. Is there a point where participants in the insurance business will say, this is getting too high, it's impeding us for doing business here? Or do you believe this is a transitory event?
No, it's already something we observe. For example, in Florida, certain risks in Florida become simply uninsurable because it's either too expensive or people or insurance companies are not willing to provide insurance coverage anymore. And then ultimately this goes then back to the general public sector if the private sector is not able or not willing to provide insurance coverage for certain risks. But it already starts in Florida with some of these hurricane exposures becoming uninsurable. I mentioned at the beginning the protection gap is the widest in emerging markets and developing countries. And there is a subsegment of the ILS market and the cat bond market developing rapidly, and that's what we call disaster relief. These are structures which provide protections for people who cannot afford or who don't have insurance in the emerging markets. And the money is used basically to reconstruct the countries, the regions, or simply to help people to survive after a natural catastrophe. As we said at the beginning, there are more and more people exposed to natural catastrophes due to climate change. And this segment here, typically issued bonds by the World Bank or regional organizations, have a rapid growth, and we expect this opportunity to grow in the future. Why is this important for the ILS market? Because these risks are not correlated or are diversifiers compared to the US hurricane risks Rodri discussed. So we will get much more investment opportunities. We get more stable portfolios, more diversified portfolios in the future. Now coming to the outlook and where do we see other opportunities? I mentioned at the beginning that we observe an increase of frequency of natural catastrophes over the last 20, even 50 years. Not really severity, but really frequency. And this basically leads to an increase of demand for protection against natural catastrophes. So we, for example, have now in the developed world hurricanes in Canada. The first time we had a hurricane in Canada. So people who were not exposed to these type of events are now exposed and will buy insurance and ultimately reinsurance protection. So significant increase of demand. Right, we have limited. So, yeah, Jan.
Yeah. So we see a number of questions coming in.
Yeah.
And one question, I believe it's already partially answered. Is there a natural limit up to which insurance companies are willing to raise the risk premiums for cat bonds?
Yeah, in terms of seasons, yeah, there is a natural limit where insurance companies will not issue cat bonds anymore because it's too expensive, but they do, on the other hand side, not provide insurance coverage for their clients. So we see already quite a number of reinsurance companies withdrawing from certain regions and perils or reducing their exposure. Because it's not economical anymore for them to provide coverage for certain risks, and typically these are the peak perils in the U.S. hurricanes and earthquakes.
Yeah. And also relating to the same topic, another question, very good, is will insurance for hurricane risk be taken over by the states in the future, and will they issue cat bonds? So yes. The question is then whether these cat bonds will then have an interesting risk return profile.
Yes, they already do. So there are natural schemes in the US, state schemes in Florida, but also in other states, which then issue cat bonds, and these cat bonds are indeed quite very attractive for investors. Because if they did not do so, ultimately the loss would then end up with the taxpayer.
And another one, you mentioned that the average period of a cat bond is 4 years. So during the last years, premium went up. New issues contracted the prices in the secondary market. Wouldn't shorter cat bonds in general help to reduce the price volatility within a portfolio?
Yeah, indeed. I mean, if we have on the private ILS, the risk period is typically 12 months, on cat bonds 3 to 4 years. Yes, it would reduce the volatility. On the other hand side, if we every year would have to roll the cat bond, then that would decrease the cost, right? The structuring cost and so on. So I think 3 to 4 years is a good compromise in terms of cost, issuing a cat bond. And the volatility we have to live with. And 3-4 years is still very short compared to other fixed income instruments.
I think it also gives people the certainty as well that they've got that coverage for a number of years.
Yeah.
This is, I believe, already partially answered, but so how can it spreads and yields go, do you think, if some is uninsurable?
Yeah, I think in Florida, we reach already a limit what people are willing to pay for their home insurance, and then also insurance company for insurance. But in other geographies like Europe, we're far away from that level. So here, yields and spreads have to go up much higher to really cover the risk.
Could you elaborate on the cat bonds correlation to other asset classes? Usually we would say that they aren't correlated, but what in case of a bigger financial crisis?
I mean, we did not observe significant or any significant correlation in financial crises. 2008, March 2020, COVID. And this is due to the short time to maturity. An average time to maturity of a cat bond portfolio is roughly 1.5 years, because they run for 3 years, right? So on the portfolio, it's 1.5 years. So the volatility is then still quite limited. So we can really say it's to a large degree uncorrelated. Okay. This brings me then to the third bullet point, and I think this is the most important message of this webinar, is that the premiums and the spreads in ILS are going up, increasing faster than the risk. So we talked about the increased risk of hurricanes, 15, maybe 20%, but the premiums go up much more and much faster. And that's the opportunity climate change creates for investors. So we see a significant increase of yield, which is much faster and more significant than the increase of risk. And that's again is due to the imbalance of capital in the cat bond and reinsurance market in general. And what we can also say is that the reinsurance industry will not have sufficient capital to basically reduce or even close the protection gap. The industry is too small, and the only way to address this and to reduce the protection gap is transferring risks to the financial markets, and in particular the cat bond market, because the financial markets are much bigger than the reinsurance industry. The instruments are there, they exist. Also, the modeling techniques exist. We heard about machine learning techniques, parametric structures. So this is all set up basically to help reducing the protection gap via the cat bond techniques. So in a summary, we can say that climate change is a big opportunity, not only in terms of risk return, but also in terms of growth of the market and a better balanced and diversified portfolio for our institutional investors.
What we do see is that climate change incurs a greater uncertainty and an increased risk. And we see that this relative increase is more prominent in the East Coast US and the major hurricanes. And what we are going to do to address this is using advanced technologies, taking a view on those risks, and also do much internal research on structuring and counterparty analysis. With that, we still have some additional questions. If premiums are expected to increase, is it then better to wait with an investment in cat bonds for investors till we reach the peak?
Yeah, I mean, the timing is always difficult. We expect premiums go up a bit further, but then there is a kind of ceiling where the insurance companies and insurance companies will not issue cat bonds or ILS anymore and reduce their own exposure. But if you have a portfolio with a yield of almost 15%, I think this is already very attractive, and a bit of spread widening will be basically lower impact on the portfolio or compensated by the higher running yield. So I think it's an excellent moment to invest in cat bonds. If not maybe now or in 2 months or 3 months, that's still very good. And we do not expect the spreads to come in again anytime soon, because the demand is still increasing for protection, and there is no signs that there is significant capital flowing into the reinsurance industry. And until we see that, we do not expect any reduction in spreads.
Yeah, but the opportunity is there already.
Yes.
One last question. We are seeing the impact of climate change gradually increasing with various future scenarios. Have you considered the likelihood of an inflection point after which the climate change is following a significantly steeper path? And if so, to what extent do you believe premiums are sufficient to compensate this risk?
Yeah, I mean, it's a big debate in academics whether there is such an inflection point where the whole climate turns into a new equilibrium going forward. We do not expect that. We see a gradual increase of frequency and to a certain degree severity of tropical cyclones. Also flood risks and others. In ILS, we were mainly exposed to hurricanes, so we exclude whenever possible flood and wildfires and all these secondary events. So we do not expect the tipping point. The question is obviously if the frequency increases further beyond what we see here, then premiums have to go up more than what we see now to cover for the risk. But at the moment, we think we are really very well compensated even for an increased risk due to climate change. So the risk return profile is much better than even 10, 15 years ago, where the risk was a bit lower.
Okay, looking at where we are now, we are coming to an end. I would like to thank everybody for the interest and the attendance of this webinar. And if you do have any questions left, please do reach out to your contact at 12 Capital. We would like to answer your questions on a one-on-one basis. So thank you very much again, and we hope to see you again on our next webinar.
Thank you.
Thank you.